Hi there, Shingirai here again, and firstly, welcome you all to 2023 and wishing you all a pleasant year ahead. Firstly, what we're going to do is look at the last quarter of 2022 and just see what happened with portfolio performance there, where if we looked at the last 3 months of 2022, 10 out of 10 of the CBAM portfolios outperformed their respective benchmarks in a relatively risk-on month where we saw portfolios returns ranging from 2.65% for CBAM 1 up to 6.41% for CBAM portfolio number 5. We did see a remarkable comeback from European equities on the back of a warmer than expected sort of winter season, and which allowed some of that natural gas or heating pressures and costs to sort of fade into the background, and thereby leading to lower inflation as reported by the CPI coming out of the Eurozone down to 9.2% versus an expectation of 9.7% as well. So there was that rebound in European equities, and you'd see that European smaller companies and Allianz Continental European up 13.7% on the quarter-to-date basis. We also saw a strong rebound in the prices of gold, and that was largely driven by some optimism around that opening or reopening narrative for China after coming out of that zero-tolerance COVID lockdown policy, and that would see demand increase for precious metals and industrial metals, and also some dollar weakness down 7.2% on the quarter would also see that as a positive for gold, and that would see our gold miners up 15.01% through 91 Global Gold. And then looking over to the detractors from performance, we did see some pullback in performance from our equity Indian subcontinent, and that's on the back of obviously India's heavy reliance on imported oil and energy, and also some downwards adjustments towards expectations for the trade balance through lower exports and potentially higher imports, which would adversely affect the growth outlook for the country, which has been adjusted downwards from a previous estimate of 7% to somewhere in the mid 6.5% range. We also saw some pullback there from our clean energy positions through Pictet and iShares Global Clean Energy, which also moved in the same direction as General Energy through crude oil, typically because clean energy solutions are associated as an alternative for fossil fuels, and you'd see those moving in the same direction over the quarter, down more than 3.6%. Moving over to a one-week basis, looking at the first week of 2023, again, 9 out of 10 of the CBAM portfolios outperformed their respective benchmarks, with returns ranging from CBAM 1 returning 0.87% to CBAM 5 returning 1.88%. In terms of positive contributors to performance, we continue to see that narrative playing out with that strength and resilience from the performance of gold miners. And then we also see that China reopening story beginning to play out through the performance of HSBC and Colombia Threadneedle China, both up more than 5.6%, as China really begins to pivot into a place where they're reopening the economy to the rest of the world and allowing visitors to begin to come back in and easing some of that supply chain pressures that we'd seen during the hard lockdowns. On terms of detractors from performance, we also saw some pullback there from Fidelity Japan. Obviously, the Bank of Japan has been somewhat lethargic in terms of interest rate hikes, but recently allowing a bit more of fluctuation in the currency, and that with some weakness in the domestic economy as well, related to China's lockdown, and also that being a headwind for Japanese economy, down with Fidelity down 1.96%. And then the narrative continues for equity Indian subcontinent down 1.64% on the one-week basis, and then some headwinds we're beginning to see for M&G emerging market bonds down 1.57%. But then again, as I alluded to earlier, Europe continues to perform well, with Europe up more than 3% on our positions coming into the first week of the year, and US dollar as well down versus sterling 1.15% on the one-week move. And speaking of US, we're just getting those latest inflation readings coming in right on mark with expectations. 5 straight months of inflation data coming in lower in the US, with the US inflation number coming in at 6.5% today, which is definitely something that the market will take as a positive, as that allows perhaps a bit more of a softer path for for interest rate hikes from the Federal Reserve Bank.